Stocks have gained 8 straight weeks. Commodities continue to sizzle. Bitcoin is bleeding. Plus, bonds. Are you overinvested? We'll talk about that and much more. I'm Ron DeLegge with ETF Guide. Welcome to the program. Great to see all of you. I hope all is well. Let's start with a couple of polls right here on ETF Guide TV in the communities section. 2 polls. The first one, public disclosures show President Trump made 3,700 stock and ETF trades in Q1. How many trades did you make? So for comparison purposes, I wanted to see what your answer was, and less than 100 was the most common answer. Almost 90% of you are in that trading vicinity, number of trades. And then 100 to 3,700, 7%. And then 2% of you said you traded more than 3,700 times in Q1. Hit me up in the descriptions or in the comment section below. I want to hear from you. I want to see all 3,700 trades, or maybe it was more than that. List them again in the comment section below. I want to see the proof. Another poll was this. Tell me what the top ETFs that you're in. And I listed some ticker symbols by areas that have been sizzling, from energy to semiconductors to uranium. The vast majority of you, more than 51 or just over 50%, were in semiconductors. So it's nice to see some of you making money in that particular sector. I've got a couple charts I'm going to share with you in a second. These are some of the ETFs in that particular area that use leverage exposure to semiconductors. We've also got energy. That's been another great trade. And then uranium, which has quietly been kind of trending higher. And then we had some comments. This was the comment section blew up on this, because then you went to list some of you the specific ETF tickers that you are in. And this was a interesting exercise, one that we should probably do more, because I like to see exactly as a community what you're owning, what you're holding, and just get kind of a vibe on the overall pulse of which ETF tickers are resonating with you. And there's a couple here that really were kind of repeating. SOX, SOXX, to semiconductors, SMH. That was another semiconductor-related ETF that made the rounds. And then QQQI, which is a NASDAQ 100 income ETF. That one also showed up. This one from Trailer Park Stock Trader. What a great username. Trailer Park Stock Trader. These are some of the ticker symbols that particular user's in. SPMO, SCHG, NLR, DTCR, a couple familiar tickers. So we've seen some of those tickers on ETF battles. And then some more comments. A couple other ETFs, NASA, DRAM. DRAM's been an interesting one. That's an ETF that was recently launched, I think, by Roundhill. And then a couple of other semiconductor ETFs in the mix. So nice to see that you're making some money, audience. That's what it's all about. This is a big picture view of the overall market, major asset classes, and the ETFs tracking them since the start of the year. And these figures, by the way, are through the market close of May 22nd. SPY, which tracks S&P 500, up just over 9.6%. And look at how far S&P 500 has come since April. I mean, it's made a really impressive rebound. Same goes for global real estate, which is now ahead by almost 11%, REET. Commodities continue to sizzle. SDCI, one of the best core commodities ETFs out there, ahead by just over 29%. And then bonds and Bitcoin continue to lag so far in 2026. In terms of, we talked about at the very outset, in terms of trends and streaks, we've got 8 straight weeks of up for S&P 500. And this was a nice table outlining the historical perspective on what that means or could portend for stocks going forward. This was from Ryan Dietrich at Carson. And you can kind of get a gander here of what happens after 8 straight weeks of up for stocks. And you can kind of see the numbers are still pretty positive to the upside. So you can see here after 12 weeks, pretty much positive or flat. And then after 26 weeks, that's half a year, there's only one period where stocks were down. That was in 1998, down 7%. And then if you look at the full year forward, 52 weeks, positive straight across the board for an average rate of return of almost 17%, 16.9. So pretty impressive results for stocks after they've scored 8 straight weeks up. So the rally might not be over just yet. We talked about SDCI. I continue to harp on it. Those of you with minimal or no exposure to commodities, put this ETF on your ticker symbol or on your radar. Again, the ticker symbol is SDCI, and it's a great core commodities ETF. Broad exposure to commodities. You get the entire basket. You get all those important commodities, not just the energy ones that are in the news, like the oil and the gasoline, but you also get all the other core commodities, including the livestock, along with things like coffee and also some metals. So SDCI, put it on your radar. And SDCI, by the way, in the context of a portfolio, where does it go in terms of architecture? That's a core ETF. So that could fit into your core bucket, something that you buy and hold for a long time. Now, in terms of S&P 500 sectors, 8 are up, 3 are down. The top leaders, really the runaway leaders, technology and energy, up double digits by a wide margin. And, you have 3 sectors that are down, and it's down modestly. So the uptrend continues for the overall S&P 500. And if you look at it by a sector-by-sector basis, still pretty positive numbers to the upside. Now, in terms of, where you might put those sector ETFs, where do they go in terms of a overall portfolio? That would be the non-core bucket, and that's because these sector ETFs are a little bit more concentrated in nature, more risky, and not broadly diversified. They're not really what we would call ETFs that are proxies of major asset classes, right? Because they're not trying to replicate the entire asset class, for example, stocks. They're just taking one tiny segment of that asset class and trying to hopefully provide performance that beats that overall area. But again, that's just the context, and I highlight this to help you understand, those of you that want to organize your portfolio in a much better fashion, this is why I bring it to your attention. This next series of charts also fit into the non-core portfolio or non-core bucket within your portfolio. And man, I had to chart semiconductors. And there's a couple of ETF ticker symbols here that really stand out. I mean, it's just been lights out for Soxal, which offers triple daily exposure semiconductor ETFs. That's from Direction. This ETF is just, since April, it's just been a rocket ship straight to the moon, up over 353%. And then SOX, which is unleveraged, that's been a great ETF too. Unleveraged exposure semiconductor stocks, that one's ahead by about 78%. Teckle, which is triple daily exposure to tech stocks, that's been a good performer. Not as good as Soxal, but nevertheless worthy of attention. Up just a nudge over 77%. And XLK, which is the technology stocks within the S&P 500, ahead by just over 25%. So that's kind of a comparison of those various ETFs versus each other. I wanted to also highlight a couple of other ETFs in the what you might call the hard assets space or critical materials space. And these are a couple of ETFs that really stand out: uranium, copper, rare earths, and silver. And these are the ticker symbols: URNM, COP, COPP, REXC, which is rare earths, and then silver, SLVR. Now you'll notice that this chart is since the start of the year, but you'll notice how these particular areas have come off their yearly highs. Now, they're still in positive territory, but they have definitely pulled back. And those of you saying, well, the performance doesn't look that sexy. Well, take a look at this chart, folks, because this is the 1 year, much bigger perspective on how these types of ETFs in this category have performed. And listen, they're having a breather right now. They're having a little bit of a pause, a little bit of a break, because if you look at the 1 year performance, it's been lights out. SLVR up over 144%. Same thing for COP and uranium, which both have delivered strong results, up over 78% and almost 100% respectively. REXC is a new ETF. I want you to keep that one on your radar. Rare earths, which a lot of portfolios do not have exposure to. This was a recently launched ETF from Sprott, and it's one that you're going to hear more and more about, REXC, rare earths. So put that one on your radar. Ex-China. Wall Street Journal ran an interesting piece about, this was an opinion piece, arguing that you're probably overinvested in bonds. And this was written by a fellow by the name of Robert Posen. And I thought it was a great article because it pointed out, his argument was, listen, if you've got a net worth over, let's say, $2 million, then there's a good chance that you probably own too much in bonds. You should have more in equities than bonds. I don't know if I necessarily agree with that. It really depends on a person-to-person and family-to-family basis. But his point is that you would have done better had you had a 90-10 split, 90% stocks, 10% bonds. That may have been true if you invested that way. Looking backwards, going forwards, obviously we don't know. The point, though, that I want to highlight, and this is the perspective that I think he did not touch on, is the fact that many investors own bonds for safety. And so in that sense, if you're using bonds for your safety cushion, and if you're using a traditional 60-40 portfolio with 40% being bonds, or any combination of that where you're relying on bonds for safety and it represents a large portion of your portfolio, then yes, I would agree with Posen's argument that you are probably overinvested in bonds. Specifically, if you're relying or looking to bonds for stability when equities begin to get unstable or go down. And you can see this is a reminder of what happened in 2022 when stocks went down. Bonds, including long-term U.S. Treasuries, sank right alongside the stock market. And so this is a reminder that bonds don't always necessarily provide that safety that you need. And in this sense, if you're using bonds, you can use them in your core or your non-core portfolio. It's okay to use bonds and bond ETFs in those buckets. But as far as your safety bucket's concerned, you should never, ever use bonds in your safety bucket, because bonds, whether they're corporate bonds, municipal bonds, government, U.S. government bonds, they do not meet the minimum standard of safety. Now, they do provide some liquidity, yes. In some cases, they may diffuse market volatility, or they may not. There's no guarantee they'll do that. But here's the problem, is they do not offer 100% principal protection. But Ron, what if I hold them to the end of the maturity? Well, you know what? You could still lose principal while you're waiting for that maturity date. The other thing, too, is you're taking credit risk. And with national debt now topping $39 trillion, we're going to start asking these questions. How safe are U.S. government bonds? Even Jamie Dimon recently said that the bond market is cruising for a bruising, and that at the current trajectory of runaway spending by the U.S. government, runaway debt, that there will be a bond crisis. And so that's why we would never use bonds in the safety bucket, because they don't meet the minimum standards of safety. And those minimum standards of safety, again, you got to provide liquidity, you have to diffuse market volatility, and then you've got to have 100% principal protection. And so this is just a courtesy public service announcement and reminder. We end our show with a look at the Bloomberg Billionaires Index. And I like to do this because it reminds us of where the big money is, how it's allocated, and also how it got that way. And you'll notice the technology sector continues to build massive wealth in the top 10. And that's a great lesson for all of us from an investment perspective to orient the portfolio more towards technology, more towards AI, more towards all the things that are shaping that digitized future, AIs in that, and all the data center stuff, and the things that are going to be required to build that out. The things like the copper, the things like, the silver, lithium, rare earths, all of that. That's all required part of this technological revolution that we're in right now. And you can see the big money is not going to be selling technology anytime soon. And so that does it for today's episode. Hit me up in the comment section below. Let me know how you enjoyed today's program and anything else that we talked about that may be on your mind. Also, be sure to check out some upcoming episodes that we've got of ETF battles, and then our playlists: Direction, USCF Investments, First Look ETF, and then, of course, Metals in Motion with Sprott. So that does it for today's episode. And it's been great being with you. I'm Ron DeLegge with ETF Guide. We'll see you on the next program.